Everyone, we're also tracking futures this morning. They're coming in mixed. This after the S&P 500. Actually, right now, we're seeing things positive across the board as the NASDAQ future is making up its mind to the positive side. But taking a look at the 10-year yield, that's dropping for the fourth straight session here we're tracking. This all coming after a weaker than expected jobs report last week, bolstering rate cut optimism. So is the market priming itself for a soft landing? Ellen Hazen, F.L.Putnam Investment Management Co. Chief Market Strategist Portfolio Manager is here with more. Ellen, great to see you as always. I mean, we had Mark Rowan, the Apollo Global CEO, join us yesterday and say, hey, soft landing, it's already here. What say you?
Well, I think it's clear that the economy is slowing, but certainly not so quickly that we're in for a hard landing. I think soft landing does look to be what's going to happen going forward. You see the labor market slowing, you see corporate profits doing actually okay, and you see the PMIs hovering around neutral. So it does look like a soft landing right now.
Ellen, when you take a look at the data, when you take a look at the recent econ data that we are getting out, it's pointing to a picture where the economy is softening just a bit. And I think as a result, we've almost seen this inflation conversation take a back seat. Is that the right way to look at this? Or do you think that this is something that could potentially here weigh on the equity markets, obviously, in the second half of the year?
Well, as we look at the equity markets, they're kind of expensive right now, at least on the large cap side. Small and mid cap are cheaper, but I think that's for a reason. So let's set that aside for the moment. So we've already seen a full year's worth of returns in the large cap market. Normally, if you go back 100 years, the average return is high single digits, maybe 10, 11%, and we're already almost there. So I think it would be too optimistic to expect higher equity returns from here going forward to the rest of the year. But having said that, corporate earnings are okay. The one thing that I do think will happen is I think inflation is going to be stickier for longer. We saw a very rapid decline in inflation from the peak in the summer of 22 all the way down to about 3%, but it's been stubbornly there for a while. And with the labor market being as tight as it is, I do think that inflation might be stickier for longer, and therefore higher for longer rates. And as we look at some of the areas that are sensitive to rates, that's going to be a little bit more problematic for them.
We've seen a lot of Goldilocks reports really need to be given to the market over the course of this earnings season. And to that end, FactSet saying that on a year-over-year basis, the S&P 500 is being rewarded, or at least rewarding positive EPS surprises less than average. Where does that tell you that there might be some profit taking that could start to be taken at this point in time, and where most notably would that be and show up?
Well, that's an excellent point. If you look at the earnings reported for Q1 in the S&P 500, both revenue or earnings are up around 4 to 5%, which is decent. Forecasts are that that's going to accelerate throughout the year, which I think is reasonable, especially given the year ago comps, the base effects. But as you look at how the stock market has responded to those earnings, what you see is that the earnings beats have been 9% in the first quarter. That is the highest percent beat that we've seen in the last 3 years. And so you would think that the market would be responding positively to that. But because expectations were so high going in, again, we've already had a year's worth of returns in just 4 months. Because expectations were so high going in, the average stock that beat was actually down on the day, the lowest response in the last 3 years. So I think what that's telling us is A, corporate earnings are fine and healthy, and that does reinforce the soft landing narrative. But expectations were high, and there's just not a lot of upside to the markets from here, given where we are already. Now, the one thing that could make that better would be if we saw corporate earnings accelerate. But with inflation remaining stubbornly high around 3%, I don't know if that's possible. I think what we see for the rest of the year is continued choppiness.
So you said that the movement here to the upside might be limited then at this point. How much higher then, or lack thereof, do you think the equity markets could go between now and the end of the year?
Maybe a few percentage points, but I don't think we're going to see another 10% from here. You could see another 5% from here, but I think it's going to be choppy between now and the end of the year. And another aspect that you see as you look forward at earnings estimates is that right now, tech and communication services, which of course have been the big winners for the last several years in stock prices, but also in earnings, they had the fastest earnings growth in Q1, and in Q2 they will also. But if you look at earnings forecasts by sector for the rest of the year, what you see is that a lot of other areas are going to catch up. Healthcare, materials, industrials. that's going to be where the earnings growth is faster toward the end of the year. So you could see the overall averages remain roughly where they are, but a rotation under the surface towards some of these areas that are going to show the accelerating earnings growth later on in Q3 and Q4.
As there's a lot of upfront spending on building out the future data centers or the future that is going to be the infrastructure for generative AI, does that mean industrials perhaps are the next big kind of picks and shovels type play for generative AI?
There are a lot of factors that go into building a data center, right? You need land, you need materials, you need construction and engineering, and of course, you also need chips. So I think it's going to be all of the above type of thing as the data centers continue to get built out over the course of this year. And there are other factors too, right? It's not just AI. You have the Infrastructure Reduction Act, you have the energy transition still going on. You need a lot of energy for that, so that's going to be electricity. So I think that there are a lot of bank shots that you can make in addition to simply owning NVIDIA.
Well, you classify that, bank shots. Okay, bank shots for generative AI. Ellen Hazen, thanks so much for taking the time here with us. F.L.Putnam Investment Chief Management Co, Chief Marketing Strategist and Portfolio Manager. Appreciate the time here today.